So today we are continuing with our first chapter, which is Introduction to Accounting and Finance. And let's check our homework assignment first. Then we continue with the first chapter. If we have a free time, we'll probably start the second chapter. So here is, we have done the accounting equation. You remember that? On the last page, you had a homework assignment. So I have got your assignments papers. So mostly have done correctly. That's very good. That means you have understood the accounting equation, what that means, and how we should prepare. That's very good. So here we have done some quick review questions, right? So I want to show you the answers, the correct answer for the assignment. Then you can compare your answer with mine. So it will explain you what's the difference. So here is just a moment. So the first assignment was about how you have to determine the appropriate amount in the space mark. Equation between asset and liability and owner's equity, right? So this is the first assignment was the correct for all of students who is actually sending me the papers. So the A1, the liabilities should be 46,000, right? This is a very easy as I should have some calculation, math calculation only. The B is 100,000, right? And the C is for 75,000. The mostly is have done correct. That's okay. So you do understand the equation one. The next one, we had some problem with the second assignment. Here is, so you should state the effects of the following transaction which is given you. The A is given as just example, how you should done. And for the B, okay, let's see the B one. The most students have confused with the B transaction, which is purchase office equipment by cash. So let's see the first one. So first we have purchased the equipment. So we have an increase in equipment, right? Here is one highlight you just a moment. So we have an increase in equipment, right? Firstly, because we have bought it. Next one, the cash. That means the cash would be decreased because we have bought it by the cash, right? So here is decrease. Totally, in the balance, we have no any changes, right? Because, for example, let's see the balance one. Image the balance. You have from the right side is liabilities and the owner's equity, right? And from the right side, we have our assets. So, firstly, we have the changes in assets. Whereas in the cash, we have decreased the money, it goes out, and the equipment has been increased because we bought a new office equipment. But the other hand, the liabilities we haven't changed because we have no any liabilities. We paid by the cash. If we buy the equipment by the credit, then liability would be increased, right? And then the owner's equity as well remains same. So any questions so far about the B transactions? So when you say, mostly you say that assets is increased, that the assets is actually, you remember the definition of assets, what is actually, they includes the cash, office equipment, the land, for example, the house, buildings, and other things. All these assets called. But inside the assets, we have changes that the cash is being decreased, becomes smaller cash, and equipment office, the equipment has been increased, right? Okay, next one is the C one. Sorry, someone is talking, but I can't hear you very well, and I just asking you to mute your microphones, please. This is Mr. Nasid Rahman. Please mute your microphones because I can't hear you very well. Mute. Dear students, yes, I know you can't hear me because someone is talking. From the students. Please, you have to mute your microphone. If you would like to talk, just hand up your, and I can give you the right to. As I can see, Mr. Rashidi he hasn't mixed his microphone. Mr. Rashidi. Yeah, I know. We have all faced some problems, internet problems. Okay, let me continue. The transaction fee. Here is the owner took the cash from the business for personal use. We have the changes in the asset would be decreased because we have taken the cash from the company, right, for personal use. And which was the cash being decreased, that means the assets being decreased. And as well, the capital would be decreased because this is the cash money, is the company's money. But the owner has taken it for the personal use, for his own using. It's not related to the business one. So, and in the both sides, which is asset and capital, we have a decrease. As well, we have a balance, right? Mostly have done court for the transaction fee, so I'm satisfied with that. So, some of you asked me to explain the first one. Okay, the first one, the transaction A. Here is the paid debts to supplier. So, what that means? That we pay debts. That means, for example, one time we have bought something, products or something else, but haven't paid the money for that. We haven't made a payment. And when we say the paid debts to supply, that means we are making the payment for our suppliers for the service which is being previously time. So, and asset being decreased because the cash goes out. For example, if we pay by the cash, it would be decreased, right? So here is given to you that assets being decreased. But anyway, if it won't be paid by cash, if it's just made by the transactions like bank transfer, as well the money which is inside our accounts, as well is our assets. And if we make a payment by the bank transfer, which is non-cash, or just make a cash one, anyway, the assets will be decreased. And the liabilities as well decrease. Why? Because our supplier, the payments which we have to do but haven't made, that means it's our liabilities, right? And will be decreased because we already made the payment, closed our liabilities in front of the suppliers. So this is the transaction A. And okay, some of you are asking about the difference between the capital and the owner's equity. The capital and the owner's equity is same things if you see in your balance or if you will need it any assignment. So capital, owner's equity, same thing, same line of transaction, same. So what else? So here is, we have done our first assignment. That's very good. So as I know, you have probably faced the problem with the B1. Because of why? Because the assignment is giving you with this like little secret that here is no change in the balance. So in the future, you would probably have to like would meet something like this. This is given for you especially to push your think more widely, not in one direct. Okay. So that's all. Any questions so far? We have done the assignment. We can move to the next one, presentations. So already we have solved the first one, the transaction A. Some of you asking me again that, so I'll explain you. So some of you say that the capital is the investment of the owner. That's right. The capital money is the investment of the owner. But say that it's liability. It's business liability. It's not the liability is different one. The capital is different one. You must see the differences. The liability that is as well the money that we have in our company, but the money which is not our own money. We have taken from the bank, for example, as a credit, or from our suppliers. That means we haven't paid for our supplier the money. We should put those debts under the liabilities. So that's all. I hope you do understood, and we can move. So okay, here is the. You remember we have done the chapter first one about introduction, and we haven't finished it yet. So let's continue with that one. So here is we have done you remember the major financial statements about the balance sheet, the accounting equation that we have done already. You know what's the accounting equation. You can do your own assignments based on it. So next one comes with accounting concepts and principles. So in this presentation, which belongs to finance, we have no any detailed descriptions, and that's why I prepared you the accounting skills, which gives more information what's the concepts and principles. So it will be the next one, the next slide. Let me show you. This is the account concept and conventions. It's under the accounting skills comes. So let's start with that. So at the end of this, you should be able to understand the application of accounting concept and conventions. So, and you should be also use the following terms like accounting adjustment and the related concepts. Just want to show you. So, introduction. The accounting concepts and conventions to provide a good understanding and justification for any accounting treatment and adjustments. So, and the accounts is actually which is the financial statements we prepare. We prepare especially to compare between the years of the company, to have some statistics data to compare our performance. For example, we can take the basic year as last year were like 2012, and the current year 2013, but it haven't finished yet anyway. So to prepare the correct any financial statement, which can be like a balance sheet or income statement or cash flow statement, you should follow the accounting concepts. This is the rights for accountants, and all the accounts they know those the concepts as their names. I mean, you should remember always. Let's start. First one calls the separate entity concept. For the purpose of accounting, an entity is assumed to be separate from its owner and also entities. You remember we have some transaction about when the owner has taken the money for his own purpose from the company. So this shouldn't be, because the business from your family budget you have a difference. It's a separate entities. When you work in the company or you have your own business, all the money concerns the business would be stayed over there. So it's remain with the business. If you have your own expenses, which is related to your family expenses, like the family budget, it would be separate from the businesses. So you just can't take any like cash money from your business and use for your family payments, like for your own payments, like make a payment for rent a house or something else, buy a food or buy some transportation. So remember always that we have different entities between the expense which is made in your family by or your own and with the businesses. So here is given one example first. Let's see one. It doesn't that you own a business. Your personal economic activities must be kept separate from the business economic activities. This is explanation in the literature words, but it's like you do your expenses separate from your business expenses. Your own expenses from the business expenses would be separately. You won't put all the money in one pocket. So I think you do understand the separate entity concept, right? So you remember this is the first and important concept for all the businesses and for all the accountants. Let's move. Sorry. The assumption of going concern. According to this assumption, the entity is assumed to continue to exist in operation in the future. So firstly, let's identify entity. It means the company, the business or organization or firm. Okay? So that means when we run the business, when we have our own company, we have to assume that it will be continued in the future, in the next years. That means when we do our financial statements, we do prepare some accounts. That means we don't close it. It will be continued for the next years. Any questions so far about going concerns? You see that the going concern, the word says that the business would be goes in the futures, would be continued in the futures. That means we won't liquidate our company, just sell everything when at the end of the year. It will be continued for the next year. Okay, next one. The assumption of monetary unit. According to this assumption, all economic activities are measured and valued in currency unit. So that means when we run the business, all economic activities, like means we do some purchases or sales, we buy something or sell, or we have some services, it all would be valued at the money and at that currency in which country you live on. What we have some weaknesses about this assumption is given to you. It receives the scope of accounting. Only transactions that can be measured in monetary terms will be taken into account. That means all the activities we do when we run our business, which is measured by the money, like we buy something, we pay for some services, it will be taken in our accounts, in our statements. But the other things, activities, won't be taken. Like, for example, you have created a new idea and you are going to use in your businesses. You have the author patent maybe it would be, but otherwise it won't be measured in the money. I'm talking about when we do the human things. Another one is assume that the value of currency is constantly stable, whereas we know that the currency value is always changing. That means when we do any statements, any expenses, firstly, when we do report, we think that the currency would be stable, but anyway, you know that the money becomes like they lose their value in the future, right? And the currency also changes, and this is also weaknesses of this assumption, because today you buy the computer, for example, today you buy the PC for $1,000, and after a few months it would be different price for this computer, right? Would be, for example, it would be you can get by the discount would be more cheaper for 800, for example, US dollars. But in our statements, we have to put that we bought the computer for 1,000, and it remains same as our equipment, like office equipment, and the price would be stable and remains as expenses in the foreseeable futures. So this one you do and this, all the activities we do in the business, we would have to measure it in the currency, which is measured in the money. It would be taken into account, into company's account. Next one, the accounting period. The lifetime of the entity is divided into certain periods for the purpose of reporting economic activity. So we have the accounting period terms in our accounting, when we do accounting in. So it means when we do any report statement, so we start, for example, examples given to you, we can take a 1 year as example. We can start to write down our account from the 1st January and finish from the 21st of December and make the reporting, right? And if you would like to do your balance sheet during the year, of course you can do it. You can start from the 1st July and finish it after 1 year, which would be at the 30th of June. So mostly all of the account statements we do for 1 year, and you can start it from the starting the year or during the year, but mostly the statements would be for longer for 1 year only. So let's move. This is accounting period. This is a simple one. Yes. So you should remember all income statement, all the financial statements have the accounting period. Mostly is during the 1 year. The next one, the principle of historical cost. This is very interesting. This is the main. Actually, is the first main. The principle which you have to consider when you do your assignments, because most students forget about this principle. What that means, according to this principle, all the business resources will be recorded based on historical cost, which is the original cost at the time of purchase. You remember I told you that when we buy some equipment, any asset for our businesses, we record by the historic price at that price that day when we have bought it, and the price, the cost for any asset would remain same. Some of you talks about the depreciation. Of course, the amortizations of the assets, which is like equipment, machine, transportation, we do. It would be held on the expenses side, but any kind of resources you have in your company would be recorded on the historic cost. which when you buy at the what price you have bought it, in the statements you put that price only. You won't put the price which is market for the current moment. Okay, you do understand the historical cost principle? If do, we can move. Next one, the principle of income recognition. So here is the true condition must be complied with before income is recognized. So that means the income recognition, that means when we actually recognize that we have income, when we can accept that we have got the income, this is a principle. The first one, the seller had performed the necessary action to obtain the income. That means the seller, for example, I am as a company, as a seller, I have done some activities to obtain income. For example, I sell some products, the goods or services I have. So the next one, income can be measured objectively. That means income is measured objectively in the money terms, which would be measured in the currency, in the money units. Like I do, for example, some services, the consulting. So I would say my consulting for 1 hour would be like $20. So this is the second, is measured objectively. That, and as well, why is $20? Because I have made some market research, and mostly the companies offer such consultants for the $20 per hour. This is just example. So objectively, you won't put the like all, for example, in the market, people offer such services for another price, like for $100 or $200. Mostly, like if it's objectively, you do analyze that would be for $20, you do the same price. But depends, of course, if who you are, as what's your company, have a brand reputation, and how it's professional, what's your experience, and so on. But we can do the measurement inside of the market, right? So next one, the income can be collected. That means I do some service like consultation. I stated my invoice that my consultation would be $20 per hour, and then the income should be collected by me. How I can collect? By cash or by the transfer banks. It depends on you and your the partners, on your customer, for example. So, and then when this is three kind of activities done, you have already collected your income. That means you can recognize that you have income in your business. That means you can accept that you have income in your company. This is the principle of income recognition. This, I hope you do understand. Sorry. So some of you are asking more explanation. So this is like, sorry. For example, I'm as an owner a small shop where I sell the fruits. Okay? When I can recognize that I have income, the first, when I have fruits in my shop, right? And when I sell them, put in the shop, show for the customer that I have different kinds of fruits, and put the price for 1 kilo. It would be like some price. Let's assume the $5 per kilo. This is second step, that I measured objectively, because I have seen in the market that most little shops or even the supermarket, they offer such fruits for $4 to $5 per kilo. So I would wonder that my fruits are fresh, so I can offer at the same price, not less than the $5 per kilo. This is the second step, when I do income, when my income is measured objectively. If not objective, for example, I put my fruits for the price for 1 kilo around $20. Of course, the customers would be wonder why I have fixed that price. If my fruits are different from those ones, maybe I bring it from Africa or something, another kind of different countries, which is far away from my home shop. Or it's like, I don't know, have some more vitamins. This is not objective, right? You have to think more logically. The fruits all are same. The quality would be, of course, we can say the quality, but won't be so big a difference. And next one, the income can be collected. Then when I have my customer, they buy my fruits and they give me money with the payment for my fruits. It would be cash or maybe bank transfer if I do wholesales. And when I already got my money, for example, from customers, that means, okay, this is now I can accept that I have income. I can recognize that I have income from my business, that I'm running the business. This is a simple assumption. But okay, but this is just was a simple sums to explain you how we recognize the income. But the question is about how we actually set our price for our product or service. This is different questions. We will move later for those ones. This is when we learn about details, how the price is being made. Okay. Next one, the principle of matching. This principle matches the expenses, the efforts, with the revenue benefits obtained from the effort. The first step, recognition of the revenue for a specific period. The second step, the recognition of all the expenses involved in assessing the revenue. That means this is, you might compare same with the accounting equations with the balance. When our expense match with our revenue, that means how much efforts I made to get the revenue, and it should be much. That like I work a lot, I have made some expenses to do my job, then I get the revenue which is close all my expenses. This is the match, the principal matching. As well, like we have in the balance sheet, you remember we have our own capital and the liabilities, the monies. This is like, and what we do, the assets. Assets all are our activities. What we do in assets, we can see all our expenses. How we use actually our capital money, the owner's money, as well the liabilities. From example, the money taken from the banks. And it would be matched, as we should have a balance between our expense and that what we do and what we receive actually. So this is a principle of matching. Any questions so far about matching? No questions. Okay, moving. So here is given for you formula. The revenue, the sales one, minus expenses would be giving you profit or loss, right? You know this formula, I hope so. So if your revenue is more than expenses, you will get the profit. If your revenue, your sales means when you do any business, you sell some products, services, is less than your expenses. Your expenses are reach higher than the revenue that you get, then you get the loss. This is a relationship given you in the picture between the revenue and expenses. In the formula here is given to you net profit. This is a common formula, revenue minus expenses. Did you get the gross or net profit? It depends when we do the income statement. When we do the statement accounting in the details, this is a common formula. The revenue minus expense would be profit or loss. In the futures, after one or two classes, we will be going to prepare the income statement, where you can identify how we can get the profit or loss, which would be how we can get the gross or the net profits. Okay. But firstly, you should remember this formula: revenue minus expense would be profit or loss. If revenue more than expense, you will get the profits. If revenue less than expense, then you get the loss in your business. Next one, the principle of full disclosure. This principle stresses for the full disclosure of all relevant information and material in the financial statement, whether in the statement itself or in the notes of the accounts. That means when we do accounting, when we prepare the financial statements like balance sheet or income statement, all the information, which is the figure shows you our information, must be open for the reader. Where did you get these figures, like expenses, or where did you get some profits? The accounts have to explain and show the improvements of those activities that we have done, some expenses, and I have some invoice for those expenses. I have a check for these expenses. The improvement should be for any kind transactions. And it is all this, the information inside the statements, in the accounting actually, all are open for the readers. The reader is, who is the reader? Is all the people who is interested in your company, who is interested to get the financial statements from your company. For example, as I am an owner for a little business, and I like to get some credit from the bank, and bank is asks me to show my balance, to show my financial statements like balance sheet or income statements. And when I do show all my accountings, if the banks would have any questions regarding some transactions, about some detailed transactions, I have to provide all the materials and information regarding it. And all this information should be open for the bank, because I'm going to get the credit, and bank wants to know how about my finance positions actually, and how I'm profitable will be in the future. You see? And this is the principle of full disclosure, the open information for the readers. So I do hope you do understand. We can move. Sorry for that. Next one, the principle of materiality. The materiality refers to the effect of an item toward the overall operation of the entity. An item is considered immateriality does not affect the decision that will be made. That means, for example, if we have some immaterial the activities on our businesses, if these activities won't affect our decisions on the businesses, we shouldn't take it. We shouldn't consider about these activities. For example, it would be I have to explain you more easily. Like for example, you have in your company two owners, like partners, okay? When you both do the decisions under the business, you do some investments. You both must accept one decision only, because you have the rights which is you have same rights when you, for example, as two partners, 50-50 rights, right? You have your you have your own opinions based on the businesses, how to make, how to run, and those one. And for example, if two partners of the business have a bad relationship, for example, they argue for something else, or I don't know, maybe they are friends actually, and they have, beside of the business, bad relationship as a friends one. But this shouldn't affect your business, your decisions when you do some investment activities which is based on the businesses, on your company. You see, your emotional things, which is effect of the business would be lived outside of the business. Sorry, someone must mute its microphone, please. Yes. I can't talk. I can't speak. So, Mr. Rashid, I think so. Or if I'm mistaken, please mute your microphones. Hard to explain. Okay, once more again. Like another one example, more simply maybe. Like family have own business, like wife and husband. This is mostly common situation we can see, right? And when you are in the business, in your company, when you do decisions, investment, you should work as a partners. You have same rights and same votes. But if you have the problems inside your family, you have like problems between the house, the wife and husband inside of your family, between your relationship, like some emotional one or something else, and those things shouldn't reflect your business, because business is separate one. The other relationships with your wife or husband as a family one would be separately from the business. And all decisions when you do in the business must be considered and evaluated objectively based on their businesses. And you have to see your like each of you as a partner, not as a wife or husband. You do a business. You are going to have some decisions to buy something else or to sell. You should be reflected as your partners only. You see, the business different one, family different one. And this is all about the maturity. Like emotional things that which is affected the two partners is immaterial, right? It's not affect your business, and shouldn't be. And it won't be considered in your business because it's immaterial. This is like materiality principle. Sorry. So I hope you do understand the maturity. If immaterial, some emotional things or something else, you have like bad mood. This is all things won't be affected your business, your decisions under your business, under your company. This is just a simple assumption. If you do understand, we can move. Another one. Okay, that's all for concepts. We have you should remember we have 8 kind of concepts. So wanna show you first page, which is one. Separate entity. First one. You remember that the business budget, family budget separate, right? Next one, going concern, that you are not closing your company, you will continue your business in the future. You won't liquidate your company. All the statements, accounts would be continued in the future period, in the next year. The monetary unit means all your activities would be considered in the business if they are measured in money. They all are measured in money. And the currency, that currency in which country you are working. Accounting period. We have the principle that all our statements the financial statements have an accounting period. Mostly it's a 1 year. Next one, principle of historical cost, which is sorry, which is means when we buy any assets or resources, all the prices costs would be recorded at the historical cost at that price when we have bought it. Next one, the principle of income recognition. We recognize the income when we, as example, sell the products. We fix the price for product objectively and get the income. We can collect it. We can collect the money. Next one, the principle of matching all our our efforts as expenses would be matched with our revenue, what we actually receive. And the principle of full disclosure, which means that all the information which we provide in the financial statement must be open for the reader, and we have to explain, give all the materials regarding it. And the materiality, as I told you, that we recognize all activities in the business which is material only. Immaterial, like emotional things, it won't be recognized in the businesses under decisions. So that's all for the income, accounting concepts. This is the principle that we have to remember as we are financial or accounts or managers. So at the end of this presentation, I have a homework for you based on the concepts. Just want to show you. This is a quick review questions. Here is, let me show. You have to fill the blank with the most accurate answer. Here is given to you A to I think around 10, 12 kind of assignments. So you have to fill the blanks with the correct answer. So please email me your answers to my email that you know already. I have given you during the next week, before the next class would be started. So here is how you can answer. This is just given to you. Okay, the quick review question. Just the answers would be like, for A, the answer like this. For B, it's like this. No need to type all the questions as well. Okay. Here is, for example, let's see the first one. The financial statement prepared on a yearly basis complies with the assumption of. You remember what is assumption? When the financial statement prepared on a yearly basis complies with the assumption. So that means, you remember, as I told you, that all financial statements have an accounting period, right? So this is the answer, right? You have given already me, so thanks a lot. As I can see, you are in the progress, you do understand. So that the assumption of accounting period. Yes, that's right. So, and after the rest of you have done yourself, and just email me, okay? That's very interesting questions for you. So as you do this assignment, you'll be better remind all the assumptions and all the concepts. Okay, so we have done the accounting concepts by today. It's 4 o'clock. Sorry. So we have another half an hour, so we can continue with the first chapter on the finance. So we have done already two chapters on the accounting skills. You remember, first one is the accounting question, next one is the accounting concepts. Right now we are going to continue with the first chapter on the finance, which is, let's see, what is the planning and control? Just want to show you. Actually, I want to give you a break for 5 minutes. Is it okay for you? I think we can do it. because we have done a lot of information. Just to continue, we need a break one. Yeah, that's okay. That's 5-minute break for coffee or for tea. So and then we will continue. I will mute my microphone just for a while. So it was a good break. I think we should do the breaks in our future classes. So now we are going to continue with the planning and control. When we are managing our finance in the companies. So first thing, we have two types of accounting in any running of business. It's the financial accounting and the management accounting. Here is given you. On the financial account, we do understand that the account for final account, that means we record all our accounts. And next one, we do some product costing. That means we settle our the price for our products, for goods or services. And the management accounting, you see, the financial account is considered about the numbers, figures, expenses we do, we buy something, or about when we acquire some assets, resources. But when we talk about the management accounting, it's all about planning and control. How we plan, how we make our planning regarding our financial management, and how we are going to control it. And like a planning, like a control, and the product costing is all about the cost accounting. We call it cost accounting because the cost account is very important in the business when we do accounting under our costings, under our expenses. But we must know how what kind of efforts we do to obtain any income, right? What kind of expenses we have in our company to get an income. So what is the plan? The plan is setting the goals and ways to achieve them. That means the first one, we have to settle our goals for our businesses, for our company, organization, firm, whatever it would be. And next one, the next step is we are going to achieve those goals. And how are we going to achieve? That will be explained in the latest. The management should not only know, this is a very, very interesting statement that for you to think a little, the management should not only know where it's supposed to be or what it hopes to accomplish during the future period, but should also know how it is best to reach these ends. That means how we are going to achieve our goals, like to get income, like to increase our revenues, or like to enter a new market. So this is very important questions. So and all the planning, when we do the planning in the financial management, it will be taken in all levels of the businesses. Like here is giving the view that even the sub-unit or some small business is involved in the planning process. And all the activities which is done in the business must be coordinated with the planning, right? Because it's very important. What you do plan and what actually you have done, and you should coordinate your planning with your actions. So what is the tool which is used in the management account to assist the management in the plan progress is the budget. So the budget, with the help of budgeting, we can control our business, right? We can make a planning. What is the budget? It's the formal quantitative the expression of the goals set by the management. In the budget, we can show how much expense we would have in the future, how much sales or revenues we will get, and who would be getting some profits or loss. So we have different types of the budgets at any organization. Let's see. The first called the master budget. The second is the function budget. We have some relevant cost budgets for special decisions and the capital budgeting. Let's see that in details each of them. What is actually the master budget? It provides the management with an overview of plans for operations. The master budget is like a main budget. When we do accounting, it would be all considered, all actions would be considered in this budget, like sales, like production, purchasing, financing, expenses regarding the business. Next one, like organizations are often faced with the need to purchase, or for example, what is a capital budget? When we are going to get to obtain to buy any kind of property, plant or equipment, or to to develop our businesses, for example, to open like new a branch, for example, we have a capital budgeting for this user. And the capital budget analysis offers several methods to assist the management in making decisions. So, for example, this is your manager, which is financial management, which means how to manage our finance. Mostly, we would consider about the capital budgeting, like how we can analyze our any kind of activities, and how we can put all the recordings in the capital budgeting, in the papers, like all our expenses and plannings of expenses and the planned features of the revenues. In capital budgeting, it helps us to make a correct decisions, the right decisions, or it's the best decisions that we would have in the future. So after the planning process has been complete, that is goals and the ways to achieve them have been determined, the thing is to do is put the plans to work. That means first we do some planning, right? We set our goals for business, what we should do to get an income. Then we should find the ways how we can achieve those goals. And after that, when we already have a few variations of how we can achieve our goals to get income, we should put all the plans to work, to make activities actually, to make a business. Go and buy, go and sell, go and do a business, get income. This is the means put the plans to work. And when your plan is already in works, when you're already running your business, selling, buying, or something else, giving it services, the managers, they have to monitor the business, the operation itself, and compare, like, with your plans and what actually you are getting, and what actually you are doing with your actions. That means this is the means when managers do this, monitor this calls the control. You control your business. Yes, right? You control it over the operations. Okay, here I have some interesting questions, like Minister Saifullah asking me, which is a better measure for capital budgeting? Is it the internal rate of return or the net present value (NPV)? All about this, the measures, how we measure our capital budgeting it would be after the next chapters. I think it would be when we have done around 5 or 6 chapters, when you will be already able to make decisions on the capital budgeting. And I cannot say which method is the best, because actually most of managers, they do combine different kind of measurements to make decisions. The best way, when you have considered about all the things, all the details, when you do any business decisions. And mostly people are, like top managers, they are combining them and finding the best solution. And as well, it depends on your businesses, like what you are going to do, like and how long it takes, time, all those the items, which is time, business, the type of your business, actually your market would be depend which measure you will be using in your decision making. And I would in the future classes, we would have special assignments on the capital budgeting, which you only have some exercises and you do decisions. And you use the measurements like IRR, you said NPV, ARR. There is a payback period. There are a lot of the tools that we can use to make decisions. And you in the future you will be able to use them in the right place and to identify which is the best for you, which fits with you, with your business, for example. And you can to identify. How actually you would identify it, and you would be able to calculate yourself all those the measurements that we have talked about, like IRR, NPV, and so on, and compare them, because each of the measurements that we have talking about, they have a different results under one decision, under one project, for example. And which is most prevailing, the results, you will be taken of this one. So you'll be a patient little, because right now we are introducing for the finance. We are trying to remind all our accounting knowledge, because without accounting skills, we can't make any decisions. I mean, because we can't calculate any like IRRs, any measurements for capital budgeting, as example. Okay, let's move. Here is the control. What is the control? So we have talked about the planning. You know what's planning, what kind of planning we have. Next one is the control. The control is includes the 4 kinds of things. First one, when we do control under our operation, under our businesses, we put the plan to work, right? That we do some actions to run the business. The second one, we're observing those plans at work and gathering the information, which means collecting the information, how well they are performing. And the information collected to see the performance of the organization in reaching its goals is often called feedback. That means observing, that we observe our business operation at work, how it's done actually. We collect all the information, how our business performs actually. For example, we can make some income statement and see, do we have any income from our operations. And then we can make some feedback based on our operations and based on our observing businesses. So this is very important. And the next one, if the plans are not on track toward attaining the intended goals as determined by the feedback, management must determine what action is necessary to get those plans back on track. What that means statement? This statement means simple. You have your plan, right? Then you do actions. You run the business. if your actions are different from your plans, for example, you have a much more expense that you are expecting, and so you have to, the management, as you are management, you have to identify what actions you have to do right now, is quickly, and which is necessary to run your business regarding your planning. You see, because sometimes we plan, our plans would be different from our actions, what we do actually in fact at the facts. Yes, right? And the third step says always you have to observe your business, and if necessary any kind of changes, you have to do it, and as quickly as possible. And before the planning, of course, you must consider about that you have some changes between your plannings and actions. And the step number 4 is taking action to remedy whatever may have caused the plans to go astray. That means this is that we have talked that if you have a difference between your plans and actions, you must face it quickly and take the corrections under your operations, under your businesses. Find another best way how you can continue with your planning. Because you have, for example, when you do run your business, you have a strategy, right? You have a strategy how you are going to run your business. You have tactics when you do some business with your partners, suppliers, or customers. And when this comes like over the outside of your planning, you must have another like plan B, what you can do, what you can change to run your business in a profitable way, right? So as you are the future top managers, because always the masters, the student with the master's degree, the students who is obtained the master's, the MBA one, they are, of course, they are planning, they are going to be in the future as a top manager or as the owner of their own businesses. And as a management, you must consider that if you have any change, you would have all the business like this. The plan is right that the actions would be different. You must have a plan B, plan C, or plan D for your business. You must consider, expect that you will have changes, and make correct, right corrections. This is for all to get to make your business profitable, right? So this is not only refers to business. For all our life or all our decision making, we should have a plan B and plan C also. If plan B won't work, then what? Then what? We should have a plan C, plan D, and so on. Okay. Next one. The control requires, what it requires? Implementation. That we implement, we do our business feedback, we collect what we actually perform, how we do perform, and we do corrective actions. That means if we need the changes, we do those changes. So, and the accountants, they use the performance reports like a feedback to help managers to control their business itself. Here is two kinds of statements you can see in the slide, that it's just for you to think like a relationship of planning and control. Here it says that the planning without the control is like a ship without the rudder. And the control without the plan is like a ship without the compass. This is for you just to think that the planning and control are very closely and have must be combined over your business. Next one, the progression from planning to control. Here is just a framework, just shows you how the planning moves to control. Like first, you remember in the planning we set the goals. We must identify our goals. Then we determine the actions, the way how we can achieve the goals. After that, we put action to work. We make a business. We run a business. We do a business, right? After that, we have gathered the feedback, the collect feedback, how we do perform actually, besides of the plans. Then we evaluate our feedback. Do we really perform good in our business? We get any income? And then if it's no, it would be different from our plans. We make some corrective actions. If it would be not different from our plans, we go in the right ways, then we continue our business with that plan, with that planning. And here is the first part, the set goals, determine actions, calls the planning. And the second part, from the put action to work and take some corrective actions, calls the control business, the controlling the business. So we always have to control our business to make it profitable. So here is one I would like to explain you some statement. Mostly have you heard about that? What is the true and fair view? This is refers to accounting. The Companies Act 1985 True and Fair View requirement is what says that the accounts must give a true and fair view of the state of affairs of the company, and if appropriate, the group of which it's part. That means any business organization or company, when they show and do their financial statements, all the information must be true. Means how much you have expenses, you must this kind of figure must show in your statement. Or how much you have got income, it would be exactly that amount in your statements. This is true and fair view. Must be like this. And I hope all businesses they refer this view. So the next one, the true and fair view is the correct statement. It's a right, like correct statement. The company's financial position as shown in its accounts and confirmed by the auditors. Like, for example, if you are like a large company, some multinational company, you know that we have the independent auditors. They can come to our offices, make some auditions, right, based on our accounting. So, and when we provide them our financial statements, and all figures, all information must be true, must be correct. And if it's not, then we would have some problems with the auditions, right, with the business. So here is, after that we continue with the concept that you already know. Here is explain you that you remember we have 8 kind of concepts in the accounting. Here it says that we have, from those 8 concepts, we have 4 fundamental concepts, which is normally the cornerstones of the true and fair view statement. The going concern, which you know already, that we assume that our business will be continues in the future. Next one is the accruals. Accruals is here is giving you which subject to prudence brings the relevant transaction into the same period of account without regard to actual days of receipt and payments. Then we have, and the consistency, the concept of treating like items like within the accounts and from one year to next year, which means the account period. And the prudence concept, making the provision for all actual and probable liabilities. So that means, the prudence means when we have any liabilities in front of our partner suppliers and banks, we must make some provisions. So any questions so far? I think you have some questions regarding the concepts, right? So, okay, the going concern you do understand, you remember. Next one, a cross concept, which is subject to the prudence that brings the relevant transaction in the same period of account, without regard to the actual dates of the receipt and payment. This is about the historical cost concept. That if we have all the expenses have made would be remain same in the future statements. Like we have our like a balance sheet, right? We have bought some like equipment. The equipment for price is around 1,000, and next year it will be remain same for 1,000. It will be brings for the next account. You see that for the same for the next period with the same account. Okay, here is about true and fair value again. It's assumed that the accounts intended to show true and fair value are based on the compliance with this four concept, unless the accounting policies declare in the notes for the account specifically. That means true and fair value, true and fair value statement, and this is as a right for all accounts must be like follow the four concepts that we have shown. So that's all for the first chapter. Any questions so far? So some of you asked me example, but I didn't answer for which example you are. No questions, yeah? So we have done three kind of topics: introduction for finance, accounting, equation, and concepts. So we have for today actually we have another chapter on the accounting skills, which is called the double entry and preparation of trial balance. So I am thinking about if we would continue right now, or we can start on the next class. Okay, I'm agree with you that it's enough for today because financial management account is quite difficult actually class. It's not about the theory, about all those things that we have to think, calculate, and so on. So the next class would be held the same Friday, this next Friday at the same time, and we continue with the chapter which is double entry and preparation of trial balance. And we will have a lot of practical exercises that would be very interesting for you. But your homework, I just want to remind you, you remember your homework is on the accounting concepts, which is quick review questions. So just please email me when you will be already done it. And the best way, if you do email me by the next Thursday. By the next Thursday. It will be, it will be 28th of February. If you will email me your answers by 28th of February would be great, because I would have enough time to check your homework. This will be, we consider that it's second assignment on the accounting skills. And I would like to remind you that all these homework assignments during our classes it's the best way if you do it. You can't, of course, maybe some of you, most of you are not sending your papers. But in your exam, when I do evaluation, I will consider those assignments which would be given during classes. For example, if you have done your exams not so good, for example, we have, of course, because the exams have some stress, and you have to think more quickly. You will have some deadlines and so on, right? And most students who is studying very good, they can get a bad mark. But if you have done your homework assignment that they were correctly have done, I will consider and I will increase your mark on the exam, when we complete the finance class, on the overall evaluation. And I have to say, your exams, the exams, they would be more difficult than this is the just simple assignments during the classes. So that means the best you will get right now points for me, I mean based from the homework assignment, then it will be added for your exam marks. And you see the homework assignment is not so difficult, and I'm giving you enough time to complete them for 1 week. It's enough time, because exam would be given for a few hours only. So this is just my recommendation for you to make to send your papers on the homework assignment. So yes, just a moment. I see your message right now. I'd like to read them. Just a moment. I know, because a lot of students have time to. So homework is a basic accounting concept. This is a quick review questions. These slides you already have in your emails. Okay? The previous assignment, which was based on the equation, no need to send me again, because I already give it you the correct answer. The best when you submit your assignments is before the next class would be start. Any questions regarding the homework assignments or the chapters we have done? Okay, some of you, I have seen the message that some of you say that the last assignment we had on the class. You remember we had two assignments. One on the class about the accounting equation, which is based on the transactions. I just want to show you that which one is. This one about the RIN. You remember? Because here is given with the answers already, the RIN we have solved on the class. This is already the solutions given to you. But after that, next assignment, which is on the quick review questions, here is no any answers for those assignments. These were your homework at the last time. This is what I am talking about right now. So some of you asking about the final exam. So let me explain you just a moment. Okay, so I'll just explain you how I have held the finance exam with the previous students. We use